What if I told you that this week, the world inched closer to a full-blown Middle Eastern conflict? Oil prices absolutely exploded nearly 13%. And yet the one asset that's supposed to protect you when the world falls apart, gold, didn't rise. It fell, almost 3%. That contradiction right there should have every investor sitting up in their chair, because it tells a story that most people on Wall Street are completely missing. And by the end of this video, you're going to understand exactly what that story is, what it means for your money, and what one massive event next week could change everything. Let's start with what happened. This was one of those weeks where the surface looked calm, but underneath, the tectonic plates were shifting. The S&P 500 climbed 0.55%. Not a fireworks number, right? But the Nasdaq, that's where the real action was. It surged 1.50%, and that gap between the Nasdaq and everything else is a signal I want you to remember, because I'm going to come back to it. Meanwhile, the Dow Jones, the old guard, the industrials, the banks, the legacy economy, it actually fell 0.44%. Think about that. In the same week, tech investors were popping champagne while Dow investors were licking wounds. The Russell 2000 small caps barely moved, up just 0.36%, basically treading water. Now here's where the dominoes start falling. Slide over to the bond market and you see trouble brewing. The 10-year Treasury yield climbed to 4.31%, up 1.51% on the week. The 30-year pushed to 4.92, up 0.63%. When yields go up, bond prices go down, and sure enough, the long-duration Treasury ETF, TLT, dropped 0.41%. The aggregate bond index fell 0.26%. Even high-yield corporate bonds dipped 0.21%. So if you're sitting in a classic 60-40 portfolio, your 40% bond sleeve didn't help you this week. It actually dragged you down. And I'm going to show you in a moment exactly how painful that math gets when both your offense and your defense stop working at the same time. But first, let's talk about the elephant in the room: oil. West Texas Intermediate crude didn't just rise, it detonated. 12.58% in a single week, landing at $94.40 a barrel. The catalyst, Iran. Headlines were flying all week. Negotiations collapsing. Trump reportedly canceling a U.S. delegation trip to Pakistan for Iran talks. Turkey floating the idea of demining the Strait of Hormuz after a potential deal. Iran hanging alleged foreign agents. This is not background noise. This is the kind of geopolitical escalation that sends energy prices into orbit, and it did. And yet gold, the asset that's supposed to shine brightest when the world looks darkest, gold futures fell 2.79% to $4,722.30. Now, gold has had an unbelievable run this year, so some profit-taking makes sense. But the fact that oil is screaming danger and gold is walking the other way tells us something critical about where money is actually flowing right now, and I promise we're going to unpack that. Real estate got hit too. The Vanguard real estate ETF dropped 1.43%. Not surprising when yields are rising. Higher rates mean higher mortgage costs, higher cap rates, lower property valuations. It's mechanical. Defensives were mixed. Utilities were essentially flat, up a trivial 0.04%. Consumer staples held up better, gaining 0.93%. People still need toothpaste and cereal, even when geopolitics are on fire. Now let's get to the part you've been waiting for. What does all of this actually mean for your portfolio? The first thing I want you to see is the divergence, because divergences are where the real information lives. When the Nasdaq rockets 1.5% and the Dow drops almost 0.5%, that's not random. That's rotation. Money is flowing aggressively into growth and technology and away from cyclical, old economy names. The CNBC headline this week literally said it. There's a split between hardware and software stocks, and corporate earnings are driving a wedge between winners and losers. This is not a broad-based bull market lifting all boats. This is a selective, discriminating market that's rewarding innovation and punishing everything else. Second, let's talk about the stock-bond correlation, because this is where it gets uncomfortable. Stocks went up modestly and bonds went down. That means they moved in opposite directions, which sounds like diversification is working, right? Wrong. Think about it from a portfolio perspective. Your bonds are supposed to cushion your falls, but when yields are rising because of inflation fears, because oil just jumped 13% and that feeds directly into consumer prices, your bonds aren't a cushion. They're an anchor. If you're in a traditional 60-40 portfolio this week, your equity side gained maybe 30 to 35 basis points on a blended basis, but your bond side lost roughly 10 to 15 basis points. Your net return was barely positive, maybe 20 basis points total. In a week where the Nasdaq alone delivered 1.5%, that's the cost of a portfolio that isn't adapted to this environment. Third, gold. Why did gold fall when geopolitics got worse? Here's my read. The market is pricing in a specific scenario. Rising oil means rising inflation expectations, which means the Fed is less likely to cut rates, which means real yields stay elevated or go higher. Gold doesn't pay you anything to hold it. When real yields rise, the opportunity cost of holding gold goes up and money rotates out, even if the headlines are scary. This is a textbook example of the market looking past the fear and pricing the mechanics of monetary policy. And speaking of monetary policy, the Fed's interest rate decision lands on April 29th. That's this coming Tuesday. That single event could reshape every assumption the market is currently making. Fourth, the risk signals. Market sentiment is reading 66 out of 100. That's firmly in greed territory. Not extreme greed, but getting there. Unemployment is at 4.3%, which is elevated enough to keep the labor market conversation alive. The yield curve spread between the 10-year and 2-year is positive at 0.53%, which means we're in a normal, uninverted curve for now. That's actually a relief after the prolonged inversion we lived through, but a positive curve doesn't mean the coast is clear. It just means the recession signal has moved from flashing red to flashing yellow. So what should you be thinking about for your own allocation? Let me give you some frameworks, not financial advice, but ways to think about positioning in a week like this. Framework number 1. If you're running a 60-40 portfolio, this week was a wake-up call. When oil spikes and inflation expectations creep back up, both your stocks and your bonds can underperform simultaneously. Consider whether your bond allocation is actually doing the job you hired it for. Some investors are looking at shorter duration bonds to reduce interest rate sensitivity, or TIPS, Treasury inflation-protected securities, which adjust their principal based on inflation. TIPS can act as a better hedge in a rising rate, rising inflation environment than traditional long-duration treasuries. Framework number 2. Defensive positioning is giving you mixed results right now. Utilities are dead money. Consumer staples are holding up but not exciting. If your defensive sleeve is heavy on real estate and long bonds, you're taking more damage than you should be in a rising yield week. Real estate, as we saw, dropped 1.43% entirely because of the yield dynamics. The question to ask yourself is whether your defensive assets are actually defensive in this specific regime, or whether they're just traditionally labeled as defensive, but behaving like risk assets. Framework number 3. The Nasdaq's outperformance suggests that quality growth and technology names are being treated as the new safe haven. That sounds contradictory, but in a world where earnings growth is scarce, the market is willing to pay up for companies that can actually deliver it. If your portfolio is underweight tech or growth, you left meaningful returns on the table this week. Now, 2 things to watch next week that could shift everything. Number 1, the Fed decision on April 29th. The market is likely expecting a hold, but the language in the press conference, Jerome Powell's tone on inflation, any hint about the path forward, that's what will move markets. If Powell signals concern about oil-driven inflation, yields could spike further and bonds take another hit. If he signals patience, the current trend could continue. Number 2, watch oil and the Iran situation. If crude pushes past $100, that changes the inflation calculus dramatically. It feeds into gasoline prices, shipping costs, food costs, everything. That's the kind of supply shock that can turn a manageable inflation picture into a problematic one overnight. Building permits and housing starts data also drop on the 29th. In a week where real estate is already under pressure from rising yields, weak housing data could accelerate the pain in that sector. Strong data could actually be bad news too, because it might give the Fed even less reason to ease. Now let me zoom out, because this week doesn't exist in isolation. It's a chapter in a much bigger story. We are living through a period where the old playbooks are being rewritten. The rate cycle that everyone expected to be a clean descent into lower rates has been interrupted by geopolitical shocks, supply-side inflation, and a labor market that refuses to crack. The 10-year yield pushing back toward 4.5%, the 30-year flirting with 5%. That's the bond market telling you it doesn't believe inflation is dead. It doesn't believe rates are coming down anytime soon. And oil at $94 with Iran tensions escalating. That's not a one-week story. That's a structural supply risk that could persist for months. Meanwhile, technology is becoming the market's center of gravity, absorbing capital that used to go to bonds, to gold, to international diversification. The Nasdaq's dominance this week isn't an accident. It's the market's verdict on where future earnings growth lives. The bottom line is this: we are in an environment where you cannot afford to be passive. A static allocation that worked in 2020 or 2021 might be slowly bleeding you dry in 2026. The investors who will do well from here are the ones who understand that asset allocation isn't a set-it-and-forget-it exercise. It's a living, breathing process that needs to adapt to a world where oil can jump 13% in a week, gold can fall while wars loom, and the Fed is about to step to the microphone with the whole world watching. If this breakdown helped you see the market more clearly, hit that subscribe button and the bell so you never miss a weekly update. Drop a comment below and tell me, are you adjusting your allocation heading into the Fed decision, or are you staying the course? I read every single comment, and the conversations down there are honestly some of the best analysis on YouTube. I'll see you next week. Stay sharp.